Hey, welcome to the podcast, everybody. Thanks for joining me. Appreciate it. Markets closed and another green day. The Dow Jones finished up 33 points on the day, about 0.25%. That was pretty much pretty consistent across the board. The only exception was small caps. Small caps outperformed up about 0.5%. And, the market, look, the big question that I'm getting right now from people commenting, people calling, just everywhere I go, the question is, what now? Now that the Dow Jones has broken out to this new high, and this is a all-time high, I guess. Now that it's broken out, what now? And of course, everybody goes back to this picture of the Dow and the S&P over the last several years, and it's a picture that shows a triple top. And people ask me, shouldn't it roll over now? Well, I mean, look, if and I've used this analogy before, but if I was to ask my 8-year-old daughter to complete this picture, and yes, she's a smart little girl, but if I was asking her to complete this picture of this, I would bet that she would probably draw an arrow down, completing the pattern. But this is the stock market. These are people that bet against each other daily, and the markets aren't that predictable. Could it roll over? Sure. If it does right here, which a lot of people are calling for within the next percent or two, that we would get some major downdraft. If that happens, once again, you have to have your systems in place in advance. The time to decide whether or not that you're going to sell is not once it's down 15% and you say, well, maybe I should sell. Have your plan in place right now. And obviously there's some things that you're going to have a stop loss on. There's some things you're going to take profits on as it's going up. But overall, in the big picture, and I talk about this all the time, you have to do a stress test on your portfolio. What would it do if? And it's not that difficult to do because we know how different securities react under certain conditions. Just go back. I mean, the last few years we've had major downdrafts. Remember 2011, we had the major downdraft after the debt downgrade. 2010, during the flash crash that summer. Even in 2012, March through April, I think September, October, we had some major downdrafts. And you can go back and look how your positions did during that time frame. But the thing is, are you prepared for it to go higher? And I would suspect that many people that do it themselves and listen to the news and the radio and the doom and gloom would probably say, no, they're not positioned for it to go higher. If anything, they're positioned for it to go lower. And when it goes higher, they get very frustrated. How much longer can this go on? But here's the deal. Again, we know that we have $16.2 trillion of debt. We know that a lot of people are struggling in this country. We know that Congress does not get along and the lowest, popularity rating ever. We know all of this. We know that there's, where our country's being financed by China. Those are all very, very bad things. And at some point in the future, the market and investors may wake up and things will go down because China stops buying our bonds or people just get scared all of a sudden. That may happen. But what else is happening is that people have been predicting a recession the last several months. It hasn't happened. We're seeing the initial jobless claims continue to fall. Whether the numbers are manipulated or not, they continue to fall. They're going in the right direction. Housing is actually doing very well, especially in certain parts of the country. We have an oil boom, an energy boom going on in South Texas and North Dakota. There's a lot of positives happening right now. And think about it, again, from an investor standpoint, why would the market possibly be going up? You have corporate profits rising. You have the job picture, although not very good, better than people thought and going in the right direction. You have housing, which is a real big indicator that trickles down into a bunch of areas. That's going in the right direction. You have the Fed, whether you agree with it or not, is being very accommodative, and investors like that free money. So those are all reasons why the stock market's going up. Are they reasons I agree with? It doesn't matter what I think. And unfortunately, it doesn't really matter what you think because you and I are just one individual. We simply watch this, and all we're able to do is invest our capital accordingly. And what's happening right now is money is coming into the stock market. Volume continues to fall, and that is a concern. Obviously, you can see it just on this picture, right? Kind of peaked in 07, 08, and since then, people are gone. They're scared. But think about all that cash that's on the sideline. And when you see every day on the news that the Dow's making a new high, it makes the investor that's been sitting out, and maybe it's the guy that sold right in here sometime, and he's missed all of this, going, you know what, maybe, just maybe I should take some of that capital that's sitting in savings, earning 0.0000225%, and put it in the stock market. So a little more comes in, and you get this chasing effect. So what happens now, to answer your question, where do we go from here? I'm not going to try to predict because I'll be honest, I don't know what's going to happen. What I do is look at what the market's giving me and invest accordingly. For example, we've talked about financials, made very good money in financials the past several weeks. Utilities, metals and mining, which we talked about here recently, look like they may be a good trade. And we talked about how they may be bottoming temporarily for a trade. There's things to do with the money, but here's what might happen. What might happen is that everybody pours in because it's broken out, smooth sailing ahead, only to see the big breakout, fake out, or as I call it, the fake out breakout happen, where it breaks out, it looks like smooth sailing, and then it reverses and we head lower. That's a high possibility. Market may suck everybody in and then turn around. So once again, what you have to be is agnostic. You have to look at this market objectively. Don't have a bias. If you think it shouldn't be going down, but it is, invest accordingly. If you think it should be going higher and it doesn't, invest accordingly. Let the market dictate how you should be investing. And that doesn't mean always looking in the rearview mirror, but that means just acknowledge what's going on. And again, for those people who are very, very bearish, they've been frustrated betting against the market, betting volatility would spike and stay there, only to see the market just smoothly go up. And it's been a very persistent market. Now, I will say this, that there's going to be a lot of people who get very comfortable with the market, and I've talked about this in the past, and they simply fall asleep. They basically take this for granted. You know, we've had a few bad days, but pretty much most of this year it's been pretty smooth sailing. And it could continue that way. But you have to look at the downside. You have to say, what if? And that's how we have to invest nowadays. Regardless of what the market's doing now, this isn't the 1990s. And for those of you who think, oh wait, won't happen again, couldn't happen again, probably won't, but what if it does? You know, again, the market turns on a dime sometimes, and what if it does? And so this isn't the 1990s where you could say, I'm not going to have anything else but stocks. I'll just invest in stocks because they always go up, and when it dips, I'll buy more. Many of you, and I've talked to lots of you, were there in 2000, lost a bunch of money. 2008, lost a bunch of money. And some of you have held through that and are going, you know what? I'm actually making some money now, but you look back at the time that you lost because of the '08 drop and having to get back in, and so there were some sleepless nights. So I think what you have to do is acknowledge that the market could continue to go up and it could obviously go down. And it can do that every day. But again, when you look at this from the 30,000-foot view of your portfolio, how much do you have in things that you know wouldn't go down if the stock market went down? How much of your portfolio is in things that are generating a high amount of income so that it acts as a buffer? You know, you're getting 8, 9, 10% on it so that even if the market goes down and the price of that security goes down, you've got something offsetting that constant income coming in. Do you have systems in place that allow you to focus on what's working and staying in those particular areas? Do you buy things way out of favor sometimes? Do you have some things in your portfolio that you trade, that you say, hey, I'm just going to buy this and I'm going to make 10% on it, 8% on it, 15% on it, and then I'm going to take it off the table? Those are all things that I think have to have in this balanced portfolio. You know, you can't live off McDonald's alone. I think somebody tried that once, didn't they? And their cholesterol went through the roof and they almost killed themselves. And I think they made a movie out of it. But, you know, it's kind of like that. You can't just have a mutual fund or mutual funds. You saw what happened in '08. You can't just be in the bond market and say, well, I'm just going to be bonds. I don't want stocks. Stocks are risky. If you only own bonds, you're being risky. Or if you only own master limited partnerships, or you only have money in your savings account, it's a balance. You have to balance this stuff out. And then the goal is to wait in different areas at appropriate times. And right now, the correct allocation has been into more stocks. That doesn't mean you abandon your long-term big master strategy. That just means the money you would have allocated to stocks should be in there right now in some form or fashion. But are we stretched to the upside? Sure. We're definitely stretched to the upside, and we're definitely due for a correction. It really looked like it was going to come a week or so ago, but we pointed this out on the podcast that was the first place that this thing could bounce because we had this uptrend. So we already had the line drawn, and sure enough, it bounced right off of that. So, and now here we are going higher. We went down below 1,500. Now we've gone up about 3%. And really in the last few days, we've seen some rotation. As I mentioned earlier, you know, you're seeing things like oil and gas exploration doing very well. You're seeing metals and mining do very well. This is something I own for a trade, more aggressive accounts that I oversee. But you're still seeing things like financials do well. You know, aerospace and defense, regional banking. These are things that are doing very well. Meanwhile, when you say, yeah, but you know, is it really risk on? Well, look at what the Treasury market's doing. Interest rates, which were coming down, are now going back up. So again, that tells you money's coming out of bonds, going into stocks, right? We're seeing the volatility index continue to fall and erase all those big gains it had. You know, that it had in just a couple of days. Those are going away. And then in the meantime, oil. We talked about oil, this $89. Remember in the podcast, we talked about that, I think last time, that this could be the first support, 89. And we're seeing it kind of bounce off of there. So let's see if oil can hold there. But again, what we're seeing is commodities coming down, whether they're grains, certain grains have been coming down, corn, things like that, oil coming down. Good for the consumer, but is it enough to overcome some of the inflationary stuff we see? College costs rising, healthcare costs rising. You know, the consumer's not in great shape. We know that. But they're still spending, and they're probably spending using a piece of plastic. But look, again, we can't solve all the world's problems, and there are plenty of them. Trust me, I get views from many different people, and they range from extremely bullish to extremely bearish, and I have to tune that out. You know, if I have CNBC on during the day, hitting the mute button is the best thing I can do. And what I have to do is just rely on my systems that I've put in place and not get shaken out by emotion. Because emotion, high emotion, bad emotion, that's when I tend to make my worst trades, and I'm sure you do as well. But as far as the stock market's concerned, it's still working right now. And look, it's due for a correction. It really is. But don't try to predict it in advance, because there's been plenty of people that have been predicting it all the way up. And once you get out, it's hard to get back in. And I made the mistake, a week or so ago, of selling out of some of my financials on this day right here. I think it was February 26th, looking like the market was going to roll over in financials, and it's gone up. But what did I do the very next day? I replaced that by purchasing different areas in small caps and utilities and some areas like that. So those things are working still, and I've been getting more invested over time with an averaging process. Not dumping it all in, but the money that I was going to have allocated to stocks, ETFs, funds, things like that, using the opportunities and averaging in. If it doesn't come back, averaging in. But all those things have a sell discipline. See, that's the key. And you have to know when you're averaging in the market, that last thing you buy is probably the one you're going to lose money on, and you can be okay with that last piece. But you have to have some kind of system in place. Otherwise, you're going to be very confused and saying, should we sell now? And again, by asking me, is this the top? I don't know. I would love to know if this was the top. But what I can tell you is that if it is the top, we typically get warning signs weeks and months in advance. If you look at the breadth of the market right now, it's making highs. The market's spreading out. Who's participating in it? It's working, and those are things that typically roll over months in advance. If it was a bear market, not a correction, but a bear market, we would see evidence of that. So those things are actually confirming the high right now. Now, in the short run, we have people borrowing a lot of money to buy stocks. Margin debt is increasing. You're seeing the volume dry up a little bit, but you're still not seeing this active antsiness to lock in profits and get out and bet against the market. And that's really needed to have some type of meaningful bear market, and we're not seeing that yet. So again, to answer, is it going to break out here? Should we be selling? That's trying to predict, and that's just setting yourself up for a disaster. So don't try to predict, because it doesn't work. What you have to do is, again, here's the cards that are dealt to you. Invest accordingly, have your systems in place, and make it more like a machine, not to where you are simply going off of emotion. So that's a little more philosophy today, because again, I think the biggest question people have right now is this triple top. And it's just sometimes these obvious places don't happen. Just because it's happened in the past, it could just do that. And I do think that we'll see some type of little breakout and then a more meaningful correction. But look, it hasn't happened. It hasn't happened yet. So we got a big jobs number in the morning coming out. I think 160,000 is the number. And you look at what's happening with housing, I would expect that number to be better than expected, of 160,000. But who knows? But it'll be a market mover. And if it's a bad number, what we'll probably see is the market sell off. It's looking for an excuse to sell off. But remember, we're starting to get into the area now is bad news good news, and is good news bad news? What I mean by that is the Fed has hinted at taking their foot off the gas. I don't think they're going to do it, and I think you don't think they're going to do it. They're going to keep printing and stimulating for months and years to come. But when they hint at it, and you get a good economic report, the market gets a little scared. What if the economy is too good? Would the Fed jump out of the way? So what you want to see sometimes is this bad news, so that the Fed will be there for us. Isn't that warped? Isn't that crazy? And again, I'm not talking about what I want, but I'm trying to let you get in the mind of what Wall Street looks at. They're very greedy people. They're very, what have you done for me lately? I want to look out the next 2 or 3 weeks. They don't care about your kids and your grandkids. You and I care about that stuff. They don't care about that. These are greedy guys buying and selling. So we have to, that's who we're playing with here, unfortunately. So sometimes things don't make sense why it's going up. But I'm telling you that a lot of the things that I look at longer term still point to the market going higher. And I'll tell you when I see some of these red flags, but I can't tell you when the next correction is going to start. It could start tomorrow, and it could be a 10 or 15% correction, just like that. And what we have to determine is when that happens, again, what things you're going to keep. You're going to get stopped out. If you think it's a correction, are you going to go ahead and average down and buy some things on those dips? Those are all things that you need to be establishing right now, not in the heat of battle. So a little bit of philosophy there, but I did want to just tell you that because this is a very important time, because this is when mistakes can be made. All right, guys, a little longer podcast than I thought it would be, but thank you for joining me. Thank you for listening. All the new members, thank you for signing up. And don't forget, we're on Twitter, we're on Facebook, we're on iTunes, we are on Google+. EggersCapital.com is a money management website. So many ways to keep up with what we're doing, what we're saying, and we're going to continue to try to put out more and more articles and things like that over the next few days and weeks and months. Thanks for joining me. Have a great evening.